Every year, 40 million tonnes of palm oil get shipped around the world. It's used in thousands of different products, but its popularity comes at a huge environmental cost. Well, now, as Louise Beale reports, Europe's first sustainable palm oil plant hopes to mend that image.
Brand new and the world's first, this palm oil refinery in Liverpool has just opened. Driven by the very latest technology, it's still gleaming. It only needs a handful of people to run it at any one time, but the director of the company behind it says the real innovation is an ethical one.
We built a plant whereby the oil is traceable right the way back to supply in Papua New Guinea. So from our own plantations, a fully integrated business that brings the oil through to the UK, refines it and sends it to a food manufacturer, and we can tell them exactly where and how and when it was made.
Demand for palm oil is soaring, and it's no wonder. Palm oil is in hundreds of everyday items, from cleaning products to your favourite moisturiser or brand of makeup. It's in junk food, healthy food, even pet food. But 30 square miles of rainforest have to be cleared every day to make way for palm oil plantations. It puts thousands of animal species at risk, contributes to greenhouse gases, and gives the industry a bad name with environmentalists. And that's why industry leaders are lining up to become partners with a company that prioritises sustainability.
As a business, it is something that we want to do. It's the right thing to do for the environment, but it's also very important to our consumers. Customers have a great deal of interest in this area, and we want to make sure that we are delivering them the products that they want.
At this factory, they're not yet too worried about any competition because currently, globally, there really isn't very much. But that's bound to change as the demand for sustainable palm oil is on the rise. And that's where this one-stop shop comes in, fulfilling the changing demands of the industry and its customers. Louise Beale, Bloomberg News, Liverpool.
Well, to talk more about palm oil and its place on the commodity markets, joining me from Dubai is Abba Ofon, soft commodities analyst at Standard Chartered Bank. Thank you for joining us this morning. Do you think that there is going to be a large demand for ethically produced palm oil?
I think if you look at the backdrop in the palm oil market, I think we see it as fundamentally bullish. There is very strong demand for palm oil, and I know that there are already measures being put in place to mitigate the effect of palm oil on the environment, and that's why the Roundtable on Sustainable Palm Oil initiative was actually formed. But I think, you know, fundamentally the backdrop is bullish. There's strong demand from India and China, and also strong demand from Europe as well as other non-traditional consumers of palm oil. So
I thought that in Germany, for example, palm oil consumption had actually fallen by something like 25%.
Well, yes. I mean, the consumption in Germany is still relatively strong. If you look at the statistics from the Malaysian Palm Oil Board for April, that is still relatively strong. But we see that as decelerating. We think there is going to be a drop in German palm oil demand. Partly to do with the euro, the weakness of the euro against the Malaysian ringgit, which is going to affect European palm oil demand. But yes, there are also concerns in Europe about the sustainability of palm oil, and there is an increasing demand from palm oil consumers to make sure that the palm oil that they actually consume is sustainable.
And in Malaysia, among the manufacturers there, is there a larger scale move to make it more sustainable?
Well, I think there is, but I mean, if you look at the what the development in the industry, and I did attend the PPAC meeting in Malaysia last year. You know, there is a move to make palm oil more to make it greener, to make it more acceptable. But there's also rumblings in the industry that perhaps the palm oil industry is being unfairly targeted. So that's the sort of feedback that I've been getting from that sector.
And obviously, India and China are going to be growing markets for palm oil going forward.
Oh yes, I mean China is the largest edible oil consumer, and India, until last year, was the largest importer of palm oil. But what's been happening in those two markets, particularly in China, is that there's large stocks available right now. So that has sort of slimmed the amounts that they imported so far in 2010.
Okay, Abba, often thank you very much indeed.
If you look at cocoa, for example, you talked about the deficit in the market. I mean, at the start of the 12-13 season, we were looking at a 50,000 ton deficit. We're actually just getting into the 13-14 season, and the deficit is now forecast by the ICCO to be around 150 to 170,000 tons. So that is quite significant. And then on the demand side as well, you know, grindings are picking up in Europe. Grindings are picking up as well in North America, and those two regions actually account for the largest consumption in the cocoa space, and that has actually caused prices to move higher. But I think in terms of trade ideas, we expect the market to pull back as we're getting into a new season. Actually, if you look at the charts, there's been a slight moderation in prices over the last week or so. We believe that the market should be trending towards the $2,500 per ton level and be flattish thereafter. So we're not so bullish from this point in the cocoa market.
Are you not so bullish enough to actually short?
I mean, well, like I said, you know, at the moment the market is trading at about 2,650 or so dollars per ton. I'm looking for the market to average to 5 over the next 2 or 3 quarters. You know, I mean, the fundamentals are still compelling, but in terms of, you know, how the market has trended over the last 6 months or so, it's actually been quite bullish, quite hot, and we just think that, you know, there is a little bit of a froth emerging in the market, which is why we're looking for prices to trend lower from this point.
Okay, but let's switch to my favourite, which is actually coffee. Can't do without it on CNBC in the early mornings. You know, coffee's had a really dreadful ride in 2012, down 37% year to date, and it hasn't changed all that much this year. What's plaguing that crop?
Again, the fundamentals are really, really sluggish in the coffee market. If you look at the 12-13 season as well, I mean, we're moving into a new season, but if you look at the numbers from the 12-13 season, we're talking about a 10% increase in coffee production, most of that coming from Brazil, and we're looking at supply. Yeah?
Is that because the weather's been favourable for the harvest?
Yeah, the weather's been good, but also, mind you, Brazil has got an on-off cycle, so it's got a biennial production cycle where 1 year is good and 1 year is bad. And the 12-13 season in Brazil was a good season, and they produced 50 million bags of coffee. That's 16% year-on-year increase, and that just really floods coffee to the market.
In longer term, we are relatively bullish relative to the curve. I think if you look at the curve as well, the futures curve is actually trading in contango. So I think the market is expecting prices to head higher as we move into next year. Yeah. I think the market has been, as you rightly said, has been hammered by surpluses. I think we've had 4 consecutive seasons of surpluses. At the start of this year, the market was a little bit at a crossroads on whether there was actually going to be a deficit. I think the fact that we haven't seen a huge reduction in Brazilian yields has started convincing players that we are actually going to see a surplus in 14-15.
Ah, okay, so on the fundamental supply-demand, I mean, obviously with the softs, you always have to watch the weather. How is that shaping up for sugar production?
Yeah, I think it's great you say that, because at the start of the year there was a huge concern about whether or not we're going to have an El Nino. In fact, I think consensus was that we're going to have a strong El Nino, and that was going to have ripple effects in some of the major producing countries like India. We haven't seen that yet, despite the fact that we are seeing, you know, sub-par monsoon rains in India. Production doesn't seem to be hugely undermined at this time, and that really, the fact that we have left from that sort of, you know, pessimistic outlook on the weather to a more sort of optimistic, benign view has had a dampening effect on commodity prices.
So, you know, not just the softs, but commos, the complex broadly, right? When we look ahead to next year, right, middle or depending who you talk to, could be earlier, could be later, when U.S. rates are supposed to start going up. The first hike in a fresh cycle up. And we've been through taper is going to wind up next month sometime, October, right? Dollar's going to pop. Not good for certain commodities. What about for softs?
I think fundamentals still play a critical role in just how the market pans out. And at this time, our view is that we are approaching a floor for a lot of the commodity prices. Obviously, sugar's been heavily pressured lower. But if you look at the grains market as well, wheat, soybeans, I think the overriding impact has emanated from the fact that there's just huge amounts of supply, ample inventories. But as we head into next year and we head into the harvest, we might not see as good yields as we are seeing right now, and that could actually start to push prices slightly higher.
My first question's got to be, well, what's going on right now with the rice price? Is it really all down to this new leadership in Thailand, or is there more to it than that?
I think Thailand is definitely driving physical rice prices in Asia, given that Thailand is actually the largest exporter, so it can, to some extent, control prices in the market. But there are also a number of isolated events happening elsewhere. Say, in Japan, for example, there's concerns about rice being contaminated after the March earthquake and the events that followed. And in the US as well, which is not a huge rice exporter, but a sizable exporter of rice. There's been a shrinking in acreage. We've heard about the weather concerns in the US, the heat, the drought, and that is affecting exportable surpluses. So Thailand, Japan, the US, all coming together and creating some bullish momentum in rice prices.
Right. Well, what does this mean for some of these other nations here? Do people who used to traditionally import rice from the countries that you mentioned look elsewhere now, look to the likes of perhaps India or Pakistan?
I think the next best option in the rice market is Vietnam, which is the second largest exporter after Thailand. But what happened in the Vietnamese market is that it sort of hung onto the apron strings of goings on in Thailand, and we did see Vietnam prices sort of inch higher as well. But these have started to come down, given the fact that there isn't actually a shortage globally. In fact, Vietnam is going to produce a record crop this year. Prices have come down, and then there's India, of course. Remember, India has a ban, or had a ban, on all things grain in the market. But India has now been looking to export. It's looking to export wheat. It's looking to export rice. And if the price is right, we think India is going to come into the market. It's going to help to dampen the pressures that the bullishness that we're seeing in the market right now.
Yeah, but when we look at it, I mean, surely these countries will look to the higher price that, well, Thailand wants to sell rice at, and don't they just get on the bandwagon and lift up prices themselves too?
Well, yeah, that is the risk. That is the risk, and Thailand's actually leading in this market. The question is, how long can Thailand continue to lead? How long can it continue to buy prices at the rate or at the benchmark that it has set? If it does continue, then yes, there is a risk that others would actually just take their cue from Thailand and keep prices at an elevated level. But my view is that as we sort of go forward, demand and supply fundamentals are going to come to bear. Like I said, there isn't a shortage of rice in the market. In fact, if you look at inventories, if you look at surpluses globally, they have been inching higher ever since the crisis of 2007, 2008. So I don't think that this is an issue which is going to be sustained over the next sort of, beyond sort of 12 months, Up to 12 months, yes, there is a risk that, we do see that elevation staying in place.
Well, okay, we get elevated rice prices. I mean, you'd almost assume there's going to be, given the growing population in this part of the world and the population growing richer too. But do we start then switching? Let's say, I mean, the correlation between wheat and rice is one which is well established.
Well, yes, but very interesting development. We're actually seeing a decrease in per capita consumption of rice in this region. As people get richer, they switch from rice to other higher protein meals, wheat, for example. I mean, there is definitely a correlation. Rice and wheat is substitutable, but the fundamentals in both markets are quite different. In the wheat market as well, I think
at the moment, the bigger correlation is between wheat and corn rather than wheat and rice, just because of what's happening in the US and the fact that the US is a huge exporter of corn and wheat, and we're seeing record corn prices, and that is pulling wheat prices along as well. We're not seeing a similar supply shock that we saw last year, particularly from the Black Sea region. So in terms of wheat output this year, Russia, for example, is looking at producing a record crop, so that is going to, at least keep a lid on just how far wheat prices can rise.
Abba, very quickly, when we look at rice, I want you to stick your neck out and tell me how much we're going to see in terms of upside towards the end of the year.
I think we're probably going to see an average of about 615 or so for Q4 for a type B rice, 100%. But I think that is going to be the high. As we sort of move out into Q1 of next year, I think the risks are going to be to the downside.
I'm joined by Abba Ofon, a soft commodities analyst for Standard Chartered Bank in Singapore. Abba, good morning. Thanks very much for joining us today.
Morning, Mark.
Let's just start off with, what's happening in Egypt and the fear that the similar sort of unrests could spread across the region and to other parts of the world. I mean, are we approaching another global food crisis?
I think we've definitely seen a significant increase in food prices, particularly grains. We've seen corn, wheat, and to some respect, rice prices rally significantly. I think there's a number of reasons why prices have risen to the levels they are at now. Supply shocks that have hit the headlines, policy responses in a number of countries, and of course what we've been talking about for a number of years now, which is that structurally there's an increase in demand, and that is contributing to boosting food prices.
In the short term, the World Bank says a solution, obviously, is targeted government aid plans for the poor, such as school feeding programs. But what about longer ahead, Abba? What solutions, what measures need to be implemented?
I think one of the things that is not talked about as much as I would like is what's happened over the last 2 years, which is that there's actually been a contraction in plantings because of significant surpluses in some of the exporting countries. So as we sort of move forward to the next season, I'm hoping to see an increase in plantings. But added to that, there is need for additional investments in farming. There's need for improvements in the infrastructure, which will help to boost yield. I think those two things are of key importance.
What about price volatility? What steps can be taken, to reduce price volatility?
I think there's just the need to improve information globally across markets, particularly in regions such as Africa, where the lack of information restricts the amount of supply that farmers can actually bring on stream. Having said that, I think there is also the need to sort of improve access to markets for some of the players in the market. I think that would help to stem volatility. I mean, there's been talk by the CFTC and some of the other exchanges to limit speculative participation in the market. But, again, that is really a kind of worms.
And, I mean, you mentioned, flooding in Australia, cold conditions in China. I mean, would long-range weather forecasting be of benefit to these developing countries?
It would definitely be, but really, I'd say, Mark, talking about the weather, it is really touch and go. The weather is quite uncertain. What we know is that there is likely to be increased volatility as far as the weather is concerned, and that is going to have an impact on output going forward. So anything that could sort of limit the damage or the potential damage that the weather can cause would be welcome.
Abba, thanks for joining us today. Abba Ofon, their soft commodities analyst at Standard Chartered Bank in Singapore.
In longer term, we are relatively bullish relative to the curve. I think if you look at the curve as well, the futures curve is actually trading in contango. So I think the market is expecting prices to head higher as we move into next year.
Yeah.
I think the market has been, as you rightly said, has been hammered by surpluses. I think we've had 4 consecutive seasons of surpluses. At the start of this year, the market was a little bit at a crossroads on whether there was actually going to be a deficit. I think the fact that we haven't seen a huge reduction in Brazilian yields has started convincing players that we are actually going to see a surplus in 14-15.
Okay, so on the fundamental supply-demand, I mean, obviously with the softs, you always have to watch the weather. How is that shaping up for sugar production?
Yeah, I think it's great you say that, because at the start of the year, there was a huge concern about whether or not we're going to have an El Nino. In fact, I think consensus was that we're going to have a strong El Nino, and that was going to have ripple effects in some of the major producing countries like India. We haven't seen that yet, despite the fact that we are seeing, sub-par monsoon rains in India. Production doesn't seem to be hugely undermined at this time. And that really, the fact that we have left from that sort of pessimistic outlook on the weather to a more sort of optimistic, benign view has had a dampening effect on commodity prices.
So, not just the softs, but commos, the complex broadly, right? When we look ahead to next year, right, middle or, depending who you talk to, could be earlier, could be later, when U.S. rates are supposed to start going up. The first hike in a fresh cycle up. And we've been through, taper's going to wind up next month sometime, October, right? Dollar's going to pop. Not good for certain commodities. What about for softs?
I think fundamentals still play a critical role in just how the market pans out. And at this time, our view is that we are approaching a floor for a lot of the commodity prices. Obviously, sugar's been heavily pressured lower, but if you look at the grains market as well, wheat, soybeans, I think the overriding impact has emanated from the fact that there's just huge amounts of supply, ample inventories. But as we head into next year and we head into the harvest, we might not see as good yields as we are seeing right now, and that could actually start to push prices slightly higher. So we're already seeing an impact on the market from happenings in Ukraine. So from what we're hearing, supply hasn't been affected yet, so there's still cargoes coming out of the Black Sea region. But the thing is, the market is adding a supply premium to the wheat market because of uncertainties related to geopolitics. So we don't know how long this is going to last for. We don't know what impact eventually the wheat market is going to suffer from this. But I think investors are being a little bit cautious at the moment and just saying, well, we were too short wheat. Let's just make sure that we're not caught in the headlines.
Is there a short-term buy here then, if you wanted to trade?
There's already been a significant rally in wheat prices. So if you look back 6 weeks ago, we're trading at 5.50 cents a bushel. At the moment, we're well above $7.
So it's too high to buy.
So, well, yeah, I would probably say, the market's looking a bit toppy at the moment. Fundamentally, there's still plenty of wheat around in the US, elsewhere. In Russia, there's plenty of wheat. So I probably wouldn't be buying at these levels, and I would be looking for the market to dip from this point going forward.
Let's talk about some of the other commodities in this space and the supply-demand balances. Where is it most imbalanced that the market may, pinpoint to take some advantage of some trading strategies?
Yeah, I think overall, there's ample supplies in a number of markets. The palm oil market, we have actually seen a rally in palm oil. That market has started to give us some of those gains because yield is improving in Southeast Asia. But the one I'm particularly concerned about is actually sugar, because going into the 14-15 season, we might actually see a first deficit in 5 years, and that is related to weather and also related to some of the structural constraints in Brazil. So that for me is a market to watch.
Has the market appreciated that, or recognized it at least?
A little bit. I don't think it's gone far enough. At the moment, the market is trading at about 17 cents a pound for raw sugar. I think we might be seeing somewhere in the region of 23 to 24 cents over the course of the year. So I think definitely one to watch.
What about India? I mean, there's prospects for higher output from India, right?
Yeah, well, absolutely. So the thing about India is, in terms of the policies, they're making the policies in India more supportive for the sugar market. But there's a lot of weather concerns. What we're hearing on the ground right now is that the weather hasn't performed up to speed. And going out into the monsoon, if we do see an El Nino weather event, we might actually see a poor monsoon, and that has an impact on kharif crops in India.
How soon do we find out about El Nino, right? I mean, you know, there's a big if over this when it comes to so many of these markets, coffee included. We just talked about it the other day. You know, at what point do we know whether there is going to be a weather event or not?
Well, you know, it depends on what you're looking at. So the Australian Meteorology Bureau is actually saying we might be seeing more of an El Nino event happening in Q4 of this year. At the moment, if you probably go and look at what the Indian board is saying, they're saying, well, it's actually you know, pretty neutral now. But if you go with what the ABM is saying, we probably would see an El Nino in Q4. Now, the question thereafter is, how severe is it going to be? Is it going to be a mild El Nino, or is it going to be a quite severe one? If it is severe, then that's really going to have a huge impact on rainfall patterns in Southeast Asia and parts of Africa.
Welcome to this Friday edition of Asia Business Report. I'm Sharonjit Lail in Singapore. Now, China's ambition to provide a secure food supply for its booming population has led to some huge business deals. This week, China's largest grain trader, state-owned company COFCO, seals its biggest global deal to date with the purchase of a majority stake in Singapore's Noble Group for $1.5 billion. The deal comes just weeks after it also bought a 51% stake in Nidera, an established Dutch agricultural trader. Now, the acquisitions will help China shore up supplies of animal feed to meet soaring demand for high-protein food. For more, let's bring in Abba Ofon, who covers agricultural commodities at Standard Chartered Bank. Welcome to the programme. Now, we know China has these huge ambitions, and as we can see in this deal, very big ambitions indeed in the commodities, in the food sector. So what implications will this have internationally?
Yeah, so what's been clear from the get-go is that China has prioritized stockpiling agricultural commodities within its national policy, one as a way of guaranteeing rural incomes, but also as a way of keeping food price inflation in check. But it's done this mainly by securing supplies domestically. But there's been a subtle shift in policy more recently, where China has lowered the threshold for self-sufficiency, so they're moving from about 90 to 95% to 80%. So what that means is that they're looking outside of China for supplies to actually help improve supplies for agri-commodities domestically. Right. And so therefore we're seeing a bit more consolidation in the industry as China looks through the supply chain and tries to acquire capability where it's seeing some deficits.
Right. Now, as you say, China's really doing this for a number of reasons. The insufficient farming resources they have to meet their food demand. But will this have implications internationally? Are we going to see prices as a result potentially rising? We've also had other factors like bad weather, political tensions elsewhere in the world that's led to a rise in commodity prices.
Yeah, absolutely. Obviously, China is an important importer of a number of key commodities, particularly feed meal like soybeans. And so when China does go into the market, it causes prices to move up. But apart from China, there are other issues, like you rightly mentioned. There's been the weather, really dry weather in Brazil and parts of India as well, which are undermining some key agricultural commodity yields. But in addition to that, you've got the geopolitical tensions in Ukraine, which is a key trading hub for oilseeds and for wheat, and that is adding to bullish momentum that we're seeing in agri-commodities at the moment.
All right, thank you so much for that insight, Abba Ofon there from Standard Chartered Bank.
And all you coffee drinkers out there, you're not going to want to hear this, so Tim, you're not going to want to hear this. Prices of the beloved little beans of caffeine going up.
Surging. In fact, the most popular kind, Arabica, is seeing the biggest rally in 2 decades, and you can't blame it all on Mother Nature. Channel News Asia's Tony Waterman tells us why.
Brace yourself for a major caffeine buzzkill. Prices of Arabica beans have surged more than 80% so far this year. And they're not expected to come down anytime soon, as the worst drought in decades grips the world's largest coffee producer, Brazil. Growers have slashed forecasts of their coffee crop by as much as 30% in some areas. Problem is, Brazil had already planned to produce less crop this year.
In Brazil, you're having an off year in the on-off cycle for coffee, which means that 2015 production is going to be slightly lower. And then on top of that, you've got poor weather for the current crop. And that's really causing a bit of a storm.
And there seems no escaping Mother Nature. Dry weather in Vietnam and Indonesia is also pushing up prices of the cheaper but more bitter Robusta beans. Add it all up, and experts say there could be a global shortfall of at least 120 million kilograms of coffee this year.
If the price of beans keeps jumping, you could find in a couple of months that your cup of coffee gets more expensive, especially if you favor Arabica coffee. That's the kind that places like Starbucks use. But if you're a Kopi drinker, then you're in luck, because Kopi is often made with Robusta coffee. And while those beans are also getting more expensive, it's not happening nearly as fast as those Arabica beans.
For now, most sellers say they're in no rush to raise prices because many are still sitting on stockpiles of the cheaper beans. But if the dry weather persists, or if El Nino hits at the end of the year, coffee consumers could get a jolt, and it won't be from the caffeine. Tony Waterman, Channel News Asia, Singapore.